Hello, and thank you for joining me. My name is Ivan Illan. I'm the founder and chief investment officer for Aligne Wealth Advisors Investment Management, otherwise known as AWAIM. And today we're going to discuss what we've been up to for the first 6 months of 2022, first half of this year, and what we see happening during the second half of this year. We'll talk about some portfolio modifications that we have made, as well as our economic forecast items that we are watching very diligently. And of course, if you have any questions, always feel free to give us a call or email us, which that contact information is at the end of this presentation. If you are a client, an investment advisory client, and you have received a DocuSign, please do complete that. Until we have that, we won't be able to affect any trades in your portfolio, which is, of course, very important. And we want you to benefit from the kind of intellectual capital that you are, have already been experiencing for years, and the kind that you will see in this presentation. So let me go to the presentation. There we are. Here are the disclosures. You can feel free to press pause and read these diligently. I encourage you to do so. And if you are looking for more meat and substance about our intellectual capital, our thinking, our research, please feel free to visit Forbes.com. And there they host my full article archive history. You can just type my name when you go to Forbes.com in the search engine, and it'll show several years worth of articles. Also, once a month, I'm a guest on the Bruce Cook Conversation Show on AM 830, about 30 minutes a month, talk about themes that usually I'm writing about in Forbes. The good stuff, portfolio modifications. Year to date, we've made 2 sub-asset allocation changes. We sold 100% of our high yield bonds in March of 2022. Proceeds went towards high quality short-term bonds. We also sold about half of our remaining S&P 500 market weight position in May. The proceeds favored an increase of small cap equity exposure. And you can see here the relative changes between the 2 different trades across all 4 of our models. And to be fair about what we are talking about and our trading activity, we'll show you, how they've been doing since we've made these trades. These are very short-term transactions, so certainly don't put too much weight into them. We certainly do not. But it is always nice to be able to see that after selling the purple line when we did, and buying the orange line when we did, that's been a good trade, and it was a significant allocation within our portfolios. So we're very happy that this has been a big contributor to the preservation of capital and our beating of benchmarks year to date. Was this type of opportunistic trading within fixed income. And of course, to be fair, we'll show something that really hasn't played out very well so far this year. Of course, our small cap allocation is a much smaller allocation than the fixed income you just saw, but nonetheless, small cap and large cap have been trading pretty much in lockstep with one another so far this year. Small cap getting beat up just a little bit worse, down about 7 since this was run on June 24th, whereas 5.6, so about 140 basis points difference there between small cap and large cap. But as I'll talk about in a minute, we're much more bullish on small cap over the next couple of years for some specific reasons. Here's a performance snapshot with regard to our ACGM Total Portfolio Solution Suite across all 4 models. And this is audited through the end of March 31st. This is net of all fees performance. And we were trailing, reverse that. We were not trailing the benchmark at all. We actually the benchmark was trailing us by about a couple of hundred basis points at the end of the first quarter across all the models. And anecdotally, I can share with you that through this end of the second quarter of this year, we've extended that outperformance relative to our benchmarks, and really that is attributed primarily to our fixed income activity and where we are parked on the yield curve, and as well as the fact that we've stayed more on the value side versus the growth side on the equity markets. Of course, we're happy to share with this in more detail if you contact us. And there are also fact sheets quarterly that will be published, which have much more information, portfolio composition, also risk metrics like alpha and beta, and all those things our financial advisor clients are interested in. So please stay tuned for that as well. And those will be on the website in the next week or so. So here's some narrative around our economic outlook and capital markets forecast across equity markets, interest rates, labor markets. I won't read this line for line. You can press pause and read this yourself. But essentially, we are seeing more stock market volatility as the U.S. Federal Reserve is really becoming not a player anymore in the treasury markets. The Federal Reserve was the #1 biggest buyer of treasuries for many years running, and now they're stepping away from the market. So what happens anytime your biggest buyer in any market steps away? Prices typically get soft, if not plummet. And in the bond market, when prices plummet, you see an increase in yields. And that's certainly what we have already been seeing. But what's interesting is the Federal Reserve hasn't even really got cooking in their backing away from this market. They're allowing the bonds that are on their balance sheet to roll off at a certain pace, and that pace kicks up another 30% by the fall. So it's our estimation, our forecast, that we'll probably see even more level sets higher in interest rates as we get closer to the end of this year, as that big buyer has exited the market. It really requires another big buyer coming in, and that seems less likely than before. So something to keep in mind. Also, dollar strength is a factor, and I'll touch on that in just another moment. Interest rates in general are going to be challenging for U.S. corporations. Most of the debt they have coming due is coming due in the next couple of years. 40% of large cap revenues come from foreign sales. So this is a big headwind for large cap companies. Essentially the goods and services of these large cap U.S. companies have become 13.5% more expensive automatically to foreign buyers. Whereas small cap companies, only 20% of their sales are to non-US buyers. So they're not as affected by a very, very strong dollar. We see the dollar getting a little weaker in the months ahead, particularly if there is a resolution to the Ukraine war, which is a primary driver of this dollar strength right now. Just the geopolitical risk usually favors US dollar. So this should wane somewhat, but the large cap revenues are still facing an existing headwind, and it takes a little time for that to run off. The U.S. economy is still running pretty hot, and it's getting colder every day, and that's with the great help of the Federal Reserve and what they want to see with interest rates, which is higher, and they want to tamp down on inflation. So they are being more aggressive, I would say, in doing that, and they need to be. And you can see here the long-term average for the U.S. Weekly Economic Index is around 1.52%, or it's a rather 1.52 figure. It's not a percentage. And right now we're at 3.57. So still running well above average, but well below where we were at the peak in the middle of 21, closer to 12. So imagine this tremendous pendulum swing right after the pandemic to a low of -11 to a +12. So there's really quite a bit more we have to cool to get back down to a long-term average. And of course, with that means potentially higher unemployment, as well as fewer job openings. And the labor markets become very critical in our assessment of where things are headed, as well as the real estate market and the transactions there, which certainly have fallen off lately as mortgage rates are now pushing again, over 5.5–6%. So times have changed quite a bit on mortgages, and we see some challenge, quite a bit challenge ahead with real estate, given the financing changes as well, both for residential and commercial, as well as oncoming supply over the next 2 years. So there are some interesting dynamics at play there that we're also monitoring. Thank you so much for joining us for this quick presentation. It wasn't meant to be a half hour. Just keep it under 15 minutes. Please reach out to us. Give us a call at 310-795-0622 in our Century City offices. You can email me at ivan@alignwealthllc.com or my associate Jacob at alignwealthllc.com, and we'd be happy to dive into all of these subjects more intensely and personally with you. Thank you so very much, and look forward to speaking with you soon. Take care.